If you were planning to retire early, the IRS may have just made that a whole lot easier because new 2026 rules were just announced, and bigger contribution limits, bigger catch ups, and more opportunities to supercharge your retirement savings are now at play. And in this financial freedom video, I'm going to break down exactly what these new limits are and how they can directly impact your retirement plan. So stay locked in. Hi, my name is Carson Graves, certified financial planner and president and CEO of the Retirement Education Center.
And my name is Andrea Graves, Director of Operations at the Retirement Education Center. For additional concepts on how to maximize your retirement, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos.
Now, before we jump into our lesson today, there are always two rules to retirement income that we like to give you. And Andrea, what are those two rules?
Well, rule number 1 is to never run out of money, and rule number 2 is to never forget rule number 1. And by the way, if you want to go deeper into these kinds of retirement topics, Carson covers them step by step in his first published book, How to Retire with Confidence: 5 of the most common pitfalls that could derail your retirement. You can get it today on Amazon by clicking in the link in the description below. So now let's dive into our topic today.
So first, let's talk about 401ks, 403bs, 457bs, and TSP contribution increases for 2026. Now, in 2026, the contribution limits to those accounts to your retirement plans will be $24,500, and that's up from $23,500 in 2025. So the IRS has given everyone who likes to save the ability to put away $1,000 more into these tax advantage retirement accounts. Now, that financial impact may not seem big right now, but when you're looking at $1,000 extra per year, if that's invested over 20 years, and let's just say hypothetically you're earning a 7% return in those retirement accounts, that's approximately another $40,000 to your retirement savings. And for employees, this is one of the easiest ways to build your retirement savings without really changing your lifestyle all that much. Another major change in 2026 that you should take note of if you're 50 and older are the catch-up contribution increases. Now, the standard catch-up contribution for age 50 and older is $8,000, which is up from $7,500 in 2025. So the total potential contributions to your retirement plan, the $24,500 increase plus the $8,000 increase for the catch-up, is $32,500 in 2026 for anyone who's 50 and older. And also for those of you who are between the ages of 60 and 63, the super catch-up is still available to you as it is this year at $11,250. This was, of course, implemented by the Secure Act 2.0 in 2022. And so for those of you who are between the ages of 60 and 63, not only can you put in the $24,500 plus the $11,250 super catch-up is what I like to call it. So your total contributions for 2026 could be $35,750. So what is the financial impact of this and why does this matter? So this is really a massive opportunity for someone who may want to retire early or simply may want to catch up and they're behind on their savings. So these next several years can be the difference between retiring comfortably or working years longer than you had planned. So this window is especially powerful because many people's highest earning years happen between the ages of 50 and 63. So every additional dollar saved now can compound aggressively before you start withdrawals or start to claim your Social Security benefits. Next, I want to talk about IRAs and Roth IRA contribution limit increases. So the IRA contribution limits will be $7,500 up from $7,000 in 2025. Now, this is both for traditional IRA and the Roth IRA contribution. So these limits are exactly the same. Now, if you're age 50 and older, that increase has gone up from $1,000 in 2025 to $1,100 in 2026. So if you're 50 and older, you're able to put away a total of $8,600 into your IRA or Roth IRA in 2026. As it pertains to the financial impact of these increases, it's not a huge increase. But when it comes to IRAs, it's not about the big limits. It's really about how you can actually formulate these additional accounts for strategic flexibility in your retirement. So, unlike a 401k, IRAs is going to give you the freedom to choose a more diverse investment portfolio. It's also going to allow for you to have more timely Roth conversion strategies as well. It can also allow for more retirement income flexibility along the way. And when it comes to IRAs, you can integrate this into your planning with Social Security also and allow for you to have a smarter withdrawal timing strategy when it comes to those Social Security benefits. Another important increase when it comes to 2026, when it pertains to your Roth IRA, are the phase out increases. Now, for single individuals in 2026, anyone earning anything under $153,000 can contribute fully to a Roth IRA. That's up from $150,000 in 2025. And any income above $168,000 in 2026, you can no longer contribute to a Roth IRA. Now, in 2025, that was $165,000. And for a married filing jointly couple, the same holds true. Those increases have been noted. In 2026, any income below $242,000 for a married filing jointly couple in 2026, you can fully both contribute to a Roth IRA. If you're over $252,000, you can no longer contribute to that Roth IRA. Obviously, you can see here on the screen, that's up from $236,000 and $246,000 in 2025. Now, what is the obvious financial impact here? One, more people will now be able to qualify for Roth contributions. And two, this is going to give you more room to coordinate those Roth 401ks or TSP contributions with your independent Roth IRAs outside of those accounts. And this matters because Roth IRA dollars, they grow tax-free and come out tax-free and does not affect your Social Security taxation. So even a single additional year of Roth eligibility can add tens of thousands of tax-free dollars to your retirement bucket. Now, the final thing that I want to point out for 2026 that will be impactful to retirees are the traditional IRA deduction phase-out limits. Now, if you are a single covered worker, that means that you're covered by an employer plan like a 401k or a TSP account. If you make below $81,000, then you are able to deduct that full contribution to your traditional IRA from your taxes. Now, in 2025, that number was $79,000. Any income above $91,000, you are not allowed to deduct any of those contributions to your traditional IRA. As you can see in 2025, that number was $89,000. So you're able to make more money and still deduct those contributions that you make to your traditional IRA in 2026. So for a married filing jointly couple, and you're both covered by a workplace plan in 2026, your income limits are $129,000, meaning that if you make below that, you can fully deduct those contributions to your traditional IRA. If you both make over $149,000, you can no longer deduct any of those contributions. As you can see, those numbers are all up from 2025. And if you are a married couple, but only one of you are covered by an employer-sponsored plan, just one, not both, those numbers are significantly higher. If you make below $242,000, you can fully deduct those contributions to your traditional IRA. If you make over $252,000, you can no longer deduct any of those contributions. As you can see as well, that is up from 2025. So what is the financial impact here? Well, one, you can deduct more of your IRA contributions. And that means that you're going to be able to keep your adjusted gross income lower. That can potentially reduce the taxes on your Social Security benefits and help you avoid or reduce those Medicare IRMA surcharges, which of course can be a huge disappointment for any retiree who's actually experienced those type of surcharges. So the moral of this video is pretty simple. Small changes can create big improvements in your retirement future. And the IRS did us all a big favor in 2026 by opening up new doors for us to save more. And whether you're trying to retire early, reduce taxes, or simply catch up, these 2026 limits give you more control, more flexibility, and more opportunity than before. And the savers who act on these changes will benefit the most. As always, be sure to speak with a qualified financial advisor in your area who can help you navigate these updates and build a plan that truly fits your life. And if you found this information to be helpful, be sure to like, subscribe, and share this video with others preparing for retirement.
After this video, please check out our other videos that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers. Please note that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for an independent fiduciary advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in our description below and go ahead and schedule a 1-hour free consultation with us today.